Welcome, everyone, and thanks so much for joining us for our State of Freight webinar for July. My name is Mary Ann Hensley. I am the Vice President of Marketing for Sonar, and I'll be your host for today. I'm joined by our founder and CEO, Craig Fuller, as well as our Head of Freight Market Intelligence, Zach Strickland. And our speakers will be here to take your questions live at the end of the discussion. For those of you who have not joined us before, if you're new to our webinar interface, you can enter any questions for our speakers through that Q&A box in your webinar console. And if you have any technical issues as you tune in today, you can reach out to our team via the audience chat in your webinar console as well. And finally, if you would like to view this webinar again or share it with your colleagues, we will be sending out a recording to the webinar tomorrow via the email that you used to register. And at this point, I will go ahead and turn it over to Zach and Craig to kick us off.
Thank you for that, Mary Ann, and thanks to everybody for tuning in to this month's State of Freight. It's been a minute since we had our last one, which was early June at Future Supply Chain.
That's right.
But I think
before that, I was out of town. I think you did it with Tony.
I did.
Yeah.
So a big chunk of time's passed.
It has been.
And we've come through what most of us consider the summer peak season. I think there's some takeaways here, but what's your hot take for the moment?
You know, I am growing increasingly bullish. The data's out there. I thought it was interesting. We're getting into an earnings season.
Right.
I think we're going to continue to hear the larger carriers still be very, very cautious about putting out, some bullishness. I think they'll continue to show cautiousness. But Triumph had some interesting information in their earnings report. Is they actually saw July look like they were seeing really strong response from the market. And so I thought the first couple of weeks of July is really telling. Triumph tends to be, you think about their core business, it's on the broker payment side, but also the factoring side. You could say they're, in some cases, on the brokerage side, perhaps prime, and then on the factoring stuff side, sort of near prime, or even subprime in some cases. And they're starting to see some action in the market, and I think that's positive. Also, I think we have to talk about the import data, because the imports are on fire. This is near record levels, Zach.
Yes, the imports are on fire. This is a fascinating thing to me as I pull up the IOTI here. And the IOTI, of course, is an index that measures 20-foot equivalent containers based on their estimated time of departure from the port of lading. So this is stuff that has yet to come into the United States. And it is going bonkers.
It is nuts. And it's telling us, this has it's a lagging, or it's an advanced indicator. Mm-hmm. The customs data lags. This is why people largely that have used that customs data have been wrong,
right,
or have been slow to respond and see the developments in the market, is that, that customs data is as much as 2 months old. And so when you look at what is being loaded currently in China or around the world, is we're seeing some near record levels in terms of volume, really touching the 2022 peaks. It's pretty profound. And it tells us, what's great about this is it tells us a lot about what truckers can expect in the second half.
Yeah, to me, this is kind of a macroeconomic look forward. I mean, when we talk about import data, not all the time does it directly transload onto a truck or onto the rail and move across the country or wherever. But I think the way to view import data is sometimes as like a 6 to 8 week forecast, almost. Like, hey, shippers.
So this data is about 6 to 8 weeks in advance of the customs stuff that clears customs.
Well, actually, this is about 14 days on stuff coming from China to the West Coast. It's about 30 days on stuff coming from China to the East Coast.
But then you think about the time gap between the time this stuff enters the United States and then ends up in the domestic supply chain is about 2 months as well.
Right.
So you think about it, what this is telling us is that Q3, particularly that September, October timeline, is going to be incredibly strong for truckers. And so I think there's a lot of optimism in this data set. The Triumph earnings report and anecdotes gave us a lot of optimism, certainly reinforced the optimism. There's also a lot of conversation about the capacity reduction that's also taking place. Then we did an article, JP reported this article a couple of weeks ago about the SBA loans. And I don't know if you have had a chance to read it, but
Oh, yeah.
it is astounding. And it's frankly was off the radar of a lot of folks, including ourselves. Coincidentally, so Firecrown is a media, own a bunch of magazines, we buy magazines. And I was looking at some deals, and there was these SBA loans that kept popping up, and they just all of a sudden in deal flow, we're seeing them pop up. And when I started researching these SBA loans, and I was astounded at the whole structure. These were loans given out specifically during COVID. They were emergency loans given out to small businesses. So they're in addition to the PPP, the Triple P program, and in addition to the employee retention credit that go to business owners. And the amount of money that we're talking about is mind-blowing. $400 billion of loans. Get this, Zach, for the first 2 years of the program, you didn't have to pay the loan back or service the loan. The servicing started January 1st, 2024. Right. So you basically didn't have any issues. Those loans are 30-year amortization.
Like a house.
at 3.75%. Yeah. Treasuries are 5.25%. And so you think about just the delta between the cost of capital and how much stimulus. We were like, okay, this is really interesting. It's off the radar. We went and actually filed a FOIA request with the SBA to get the data because they didn't have it on their website. And we wanted to know about transportation companies specifically, trucking and warehousing and brokerage. How many of those companies actually took out loans? And the numbers were off the charts. $37 billion, nearly 10% of the entire of those loans went to trucking companies. On average, trucking companies borrowed, again, not having to service it, $90,000. And if you put that in perspective, an average owner-operator will generate and sort of take-home pay $65,000 to $70,000 sort of after taxes in a good year. That's what a good year owner-operator should make. This was basically potentially 2 years of, it explains how all these small carriers have been able to hang out as long as they have and still lose money operating their trucks.
Right.
And so this capital that's gone into the industry has just flooded the industry of the participants. And it really puts the wrapper around all of the other factors that we've talked about, the brokerage proliferation, a lot of the other stimulus that was given out, the high rates and the short up balance sheets. But this particular SBA bill and this funding program explains how so many small carriers, and by the way, it's not just small carriers, up to, I think it's $32 million is the size, your revenue, your top line. You get it. And that's a couple hundred trucks. And so we're talking about really explaining the freight recession. And this is the reason that this freight recession has been so unusual. This is the reason that the dynamics of this particular downturn have been operating like any other. Like how did small carriers survive when all the data suggests they shouldn't? But it also tells us the reason we should be bullish is that funding program is the loans still exist, but people have to pay it back. And so because they have to pay it back, they're having to service that debt now, and there isn't a cash stimulus coming in the door. So we will see an accelerate. Do you remember, we've talked about this a number of times, that there were all these there was all this conversation around bankruptcies and the bloodbath, and it just didn't happen. Right. Like, we got that wrong about this concept of the bloodbath. Just didn't happen as fast as we all expected it.
It hasn't manifested yet in the way that we thought it would in like this massive
It hadn't manifested until this year.
Right.
Like, if you go back to 22 and 23, we thought incorrectly that, or at least I did, there was going to be a surge excess of bankruptcies. And we talked about this a lot, which is, even if you take FreightWaves.com sort of editorial coverage of bankruptcies, the stories were not that common. Right. Like, we were doing, maybe 1 to a month versus back in 2019, we were doing, I think at one point 10 a week.
A week, yeah.
We are now seeing in the last, particularly 3 to 4 months, we've seen an acceleration of bankruptcies, and these are sizable bankruptcies. And so I think what's happening is all of the sort of negative market conditions have started to pile up in the industry, and the operating deficits are piling up. That's why BMO has come out and had that largest amount of bad debt reserves that they've had in many years. And it's telling us that this capacity washout is taking place. We're seeing it leave the industry. We're seeing the imports really grab. There's going to be a lot of people pre-stocking. I am bullish, and you should be too.
I am bullish. I think I've been bullish for a minute, and a lot of I guess my level of bullishness may be the thing that I would question is, I think one of the bigger questions around the market, and that I get often, is when is it going to happen? When is this going to manifest?
This is there is something I think we should talk about, is the election. And we've dodged the question or haven't dug into it. I shouldn't say dodged it. We kind of didn't have a strong thesis about the election in terms of its impact on freight. I actually think now that, look, the Democratic Party, there was reports just a few minutes ago that Axios said that Biden may step down as the nominee. Like, he's getting a ton of pressure to actually step up. It is a long shot, I think, at this point for a Democrat to pull out, because they now have got this whole name recognition problem of like, whom do they introduce to America? But we're not here to talk politics. But I think largely for many people, the presidential side of the race is, at least in many Americans' minds, is more than likely Donald Trump. And if you're running a supply chain, you're already thinking about what a Trump economy looks like. You've got import issues. And I think what was happening is there was a lot of people waiting to see what happened in November, because we largely believed it was going to be a tight contested race. It no longer appears that way.
Right.
And I think what we'll end up seeing is a surge of imports, continued acceleration of imports. I think we'll see a lot more optimism just because there's clarity.
Right.
Whether you love a Donald Trump presidency or absolutely hate it, businesses want clarity, consumers want clarity. We know that Donald Trump likes substantial tax cuts, which is going to create a lot of optimism. He loves things like accelerated depreciation. Tariffs are, something he's never met a tariff he doesn't like. And so you think about that, this is an economy that is going to be stimulated. And I think that's going to create some optimism where some of the economy looked tired. I mean, we could talk about housing. We should talk about housing here in a second. But I think that optimism, the idea that this sort of like inevitable dread of the last part of this calendar into the election was going to just be a lot of anxiety. I think the fact that it looks somewhat at least settled at the presidential side of it, will, I think, create some momentum headed into next year. Because I think businesses have to prepare, and I think there will be a level of confidence just because there's more certainty of what a Donald Trump presidency looks like versus a Biden presidency or stay in the course. And that tends to be more favorable to freight and goods consumption.
Yeah, and I think to a lot of the questions around the federal rate, situation, the rate cuts are more on the table than they have been.
I mean, look, I think you have to be, pretty positive about, inflation is under check. It's not solved, but at least is under wraps. We're not in a deflationary environment, but we're not seeing growing inflation.
Right.
And so we're seeing a situation where the cost of products and sort of the unpredictability is going away for a lot of different product categories. And because of that, I think the Fed will start to feel a little bit more confidence about lowering interest rates. The housing market is a reason we should all be concerned about the economy, if there is a reason to be concerned. So a lot of people are pointing out the macro story. And look, it's important, but as it relates to freight specifically, capacity is coming more in balance. There's a lot of sort of nuances to a Trump victory in 25 that will actually create a lot of freight demand, regardless of the economic activity. It's not like the U.S. economy is going to shut down regardless, And so I think a lot of companies are starting to prepare and will bring imports in. We've seen this play out a few times, certainly and most notably back in 2017 and 18 when Donald Trump's first tariff threats came into effect.
Right.
And businesses really brought a lot of inventory in, and I think we'll see that. So for 12 months, I think you have to be bullish on the freight market.
I think, like you said, the housing market, well, it's kind of been sending mixed messages over the last several months. But the labor market too looks like it started to show signs of cracking a little bit. Do you have any concern there?
No, I think the labor market is definitely cool. Labor is cooling down. You hear a lot of stories about, people that are having a harder time finding jobs. People are staying in their employment a lot longer than perhaps they did 2 years ago.
Right.
The sort of COVID extremes, if you will, have calmed down. It feels like a pretty stable labor market. There are a number of large companies we've seen layoffs, but these have been recurring. I think this SBA thing is actually interesting because I think it's propped up a lot of small businesses.
Yeah.
As a small business, at one point we were a small business and I look at a lot of small businesses in terms of acquisitions. What I typically find among small business owners is these are typically owners that will fight tooth and nail to keep the staff. They're not growing. They may have gone from 10 employees 1 year to 11 or 10 to 9. The staff is pretty stable. They tend to have long tenure. They tend to be very reluctant to cut their teams. They have personal relationships with these people, and also, if they're not working out, they pretty much get rid of them pretty quickly because it's their money.
Right.
And so I think small businesses, we may see some pressure in terms of employment there, where some of the capital isn't supporting them. And that may have propped up parts of the economy that probably shouldn't have been propped up. I mean, some of the businesses we've looked at Firecrown, frankly, those businesses do not have sustainable business models or do not have sustainable enterprises. And the only reason they have survived for the last couple of years is because of the government stimulus.
Right.
And short of that, these businesses would cease to exist. And I think we've not seen the level of bankruptcies that you would have expected. And I think we'll start seeing that accelerate. That will ease up some of the labor market, I think. And that would be something that will give the Fed
You worried about the debt at all?
pause. I'm sorry?
You worried about any of the debt?
Look, am I worried about the debt short term? No, it doesn't seem to be an issue. Like, we've had this debt conversation in the 90s. You and I were in high school in the 90s.
Right.
I remember when it was Clinton and Newt Gingrich and they were balancing the budget, and the deficit clock was there. We're a fraction of that. Look, I think long term you have to be worried about it, and perhaps even in the next sort of decade, my kids. But as it relates to the freight market in the next 12 months, I don't think the deficit has anything to do with it.
Okay.
I do have a sort of an interesting, what we'll see with the Trump presidency is substantial, probably tax cuts that will goose the economy.
Right.
And I think we'll see tariffs that will have the opposite effect. But what you will see is that supply chain organizations are resilient, and those professionals will find ways to basically bypass the tariffs whenever possible.
Yeah, and I think one of the things we talked about on this show or this webinar is that we haven't really had a demand problem.
No,
from the freight market perspective.
We've had a capacity problem.
Yeah, we've had a capacity problem, and it's hard to look at these demand indicators and say, okay, this is my read on the entirety of the freight market. I've been looking more and more over the last several months at the outbound tender rejection index as a whole as kind of our barometer.
It is. I think it's a fantastic
gauge.
signal of what's going on.
So let's pull that up real quick because I want to get your take here because I just wrote a Chart of the Week article about this index following 2019 and being kind of the playbook for the rest of the year. Like if it were me and I was running a business and I relied on capacity in any sense, whether as a transportation service provider or manager, I would be looking at this index and saying, okay, this is kind of how I'm going to play out the rest of the year. Of course, as soon as I do this, it breaks out. It breaks out. So what is your take here on the white line, of course, being the current year? 2019 is the orange line. And 2023 is the light blue line crawling across the floor, which we have seemed to have really separated from here the last 2 to 3 months.
I think we're back to normal seasonality in the market. We were back in sort of that June, July period. Like, people have talked about how soft it is. If you're hauling flatbed, you're definitely struggling from the lack of housing.
Yeah.
But I think this import data, this inventory restocking combined with less capacity is suggesting that we could see that breakout from here on. I think the second half is going to be pretty strong. And the reason I think it's going to be pretty strong, I mean, look at the stock market. The stock market, it's not the big ticket, the big tech companies, the AI-driven companies that are actually now breaking out. It's the Russell 2000, which is all the small businesses. And we're starting to see a change in regime in the stock market to go to more small businesses, which have really missed the rally for the last couple of years, that is suggesting that there's some optimism that could return. And look, so much, whether you have stock or own stock, doesn't matter. I mean, a lot of Americans, I think, 45 or 50% of Americans own stock, either directly or indirectly. The reality is a lot of business owners do own stock in something, and they do care about the stock market. There's a lot of, a lot of balance sheet elements that come into that.
Right.
That, as those stock prices will increase and there's a lot more optimism, I think you could restore some business confidence and leader confidence. We'll encourage things like CapEx, capital spending, and big ticket, which has been struggling. I mean, boats, we have a boating publication at Fire Crown. The boats, in terms of new orders or new sales are off something like 40% because people aren't buying boats in certain product categories, not
container ship boats.
No. I'm talking about
the
consumer
actual,
pleasure boats that were really popular during COVID. They're down significantly, sharply.
Right.
So in housing, we've talked, a little bit about that. Is people aren't making big ticket purchases. If there's a level of consumer confidence that comes into the economy, then I think it could be really bullish for what we may call a recession right now, even a broader, touching on a contraction in some parts of the goods economy. Certainly, housing is a good example of that. You could start to see some more enthusiasm in the second half of the year.
Yeah, and I mean, it's hard to imagine. So I'm pulling up the outbound tender volume index just for perspective. I know I talked about how demand wasn't really being a great indicator because this demand is being spread out amongst way more carriers. So you're losing share, you're gaining share, and then the overall figure doesn't.
It's not a
look
good
as
indicator
good.
for your business.
Yeah.
It's a good indicator for the
economy,
market,
yes.
And the freight market economy and the freight economy. And what it is telling us is that volumes have continued to be pretty robust compared to 2023. And it's telling us that all the stuff that you think about, and housing's probably the poster child of the worst performing part of the economy. And look, housing's obvious.
Right.
Like, there is always demand for housing. It is directly tied to interest rates. And so if we see, and the cost of building up, but mostly an interest rate problem is the cost to finance housing. If we see the Fed start to cut interest rates, and that looks absolutely like it's going to continue to take place, then I think we can see some folks that are.
So if I'm reading you correctly, the outbound tender volume index, which has been growing steadily, it kind of flattened out over the first quarter and somewhat into the second quarter, but it's popped here in the summer. But you're telling me that this second half of the year, you don't expect the OTVI to really have any structural problems here. I mean, you're being supported so far in the way that it's staying elevated.
I don't think OTVI is going to have problems. Yeah. I think if we had a contested election, there's a lot of reasons to be pretty pessimistic about the second half. You would, in terms of the broader economy.
Right.
But I think Fed cutting interest rates is bullish. I think this import tariff regime threat, whether or not that's a good thing long term, we can debate that all day long. It is a good thing short term as it relates to freight demand because it drives a lot of freight. It also is going to force companies to think about investing. Like the fact that, Biden has not reversed a single one of Donald Trump's tariffs from his first administration. In fact, Biden's increased some certain tariffs on certain types of products. EVs are probably the most obvious example of that. But what we've got is this really interesting economy where we have industrial investment and expansion in manufacturing. We're up to like $280 billion in industrial investment in the United States of new projects, combined with all of the the import stuff that's happening, combined with companies thinking about moving their supply chains closer to home. All of that stuff is going to really play out, and we're going to see the benefit of that.
So I want to stick on that for a second. So the industrial economy investment, like the industrial production investment and manufacturing, nearshoring, all have kind of relationship here. That's a divergence from what we have largely been doing in America for the last 20 years, which is relying on imports and things from China, Asia, coming in through the ports of Los Angeles, Long Beach, New York, New Jersey, Savannah. I have the outbound tender volume index for Ontario pulled up here.
Ontario, California. Yeah.
Los Angeles as well. If we can pull that up for the rest of the people here. The growth rate in this exceeds most other places in the United States.
Yep.
Do you see this, like what you're talking about though, would potentially reduce the exposure to the Southern California markets?
It hasn't shown up yet. Now, on a market share basis, that Inland Empire, there's a ton of, like, if you think about is the Port of LA, which if you look at the imports are still flowing into our economy.
Right.
Like we're seeing a situation where imports have been bounced back really incredibly over the last, say, 12 months, even 18. You could argue since sort of late 2022, and it's been on a tear. It's on a tear.
Steady
so
rise.
That freight is hitting Port of LA, and then because a lot of it is inventory stocking, there's another thing is that the Chinese domestic economy is not doing well.
Right.
And those companies they're moving product because that's what drives their economy. The domestic Chinese consumer is not consuming.
Right.
The policy decisions made when China joined the WTO. It was an interesting chart JP Hampstead, who's one of our analysts, and I were looking at earlier, is that if you look at the number of manufacturing jobs in America since the year 2000, there was a sharp drop off. That was the year that China entered the WTO. And the bet that American businesses and policymakers made was that China was going to open up its domestic economy to US companies. Just didn't happen.
Right.
And a lot of the consumption has been that Chinese middle class has been driving a lot of consumption. Well, those Chinese consumers have pulled back aggressively since since COVID and since then. And they're still producing a lot of product, and they got to find some place to sell it. So they're selling it to American retailers. One of the interesting things that I talked to a large company in supply chain, public company, and so I'll refrain giving specifics, that was talking a lot about the types of projects that they're involved in. And they said that it's interesting because all this import volume is flowing over, but they're not seeing the level of sort of new project exploration that you would expect if that was what they saw historically. And what we've concluded, and this goes back to what we saw during COVID, if you think about the COVID peaks of all the container flows, and you may remember this whole thing, is if you look at the number of bill of ladings per TEU, what drove the COVID extremes were the big box retailers and big companies driving it. The number of bill of ladings, which is what most people look at in terms of customs, didn't move that much. It moved up something like 15%, but the actual volume that we showed on IOTI is up like 40%. And the reason is that it was the big box retailers and the big companies that had gone from, say, 1.2 containers per bill of lading to like 3.
Yep.
And so you had this hugely exaggerated number of containers. That is exactly what's happening again. Is the reason that you're not adding new projects inside the United States is because the big companies already have those infrastructures. They already have the network of warehouses. They already have these distribution and supply chains. They are not needing to add distribution centers or supply chain locations or plants because they already have that infrastructure. And because they have that infrastructure, that's why they're not asking for new projects. That's who's driving the volume, is all the big companies. They're the ones that are buying products in China on the cheap. They're the ones that are taking advantage of the price discrepancies and basically Chinese manufacturers dumping goods on the American consumer. They're the ones that are benefiting from that. And what that's actually enabling us to do is lower the cost of those goods to consumers. So that inflationary number is actually showing up. Now, what happens with tariffs? We can talk about that a bit. But short term, this is bullish.
So do you not think, based on that statement you just said, do you not think that maybe this volume is like pull forward?
Inflated?
Yeah, it's too much.
Absolutely he's inflated. But let me tell you why you shouldn't worry about that.
Okay.
Because what we're going to see is potentially significant income tax reductions, a new tax regime, which always, you can go back to when George W. Bush was in the White House, is anytime you reduce taxes, there is an immediate or near-term stimulation that happens to the economy because businesses go out and spend money, consumers spend money, it drives the economy. So there will be a surge of activity. Now, we talked about the deficit, which is an entirely different deal.
Right.
But there will be a surge in activity. And it is almost certain that that will be one of the first things that the Republicans do is they implement significant tax reductions to consumers. That's part of their whole policy and foundation. The second thing on these tariffs is really interesting is that whether or not we end up with 60% tariffs like Donald Trump has teased on China, or even 10% tariffs on products around the world, if you're running a supply chain and you're not thinking about that and preparing for that, then you are going to be late. And what we're going to see is that supply chain professionals are going to be taught, their CFOs and CEOs, which are far more in tune with the political taxation and import tariff things than they are about supply chains, are going to be asking their teams to start planning for this, which means more production back to the Americas. It means more imports and inventory back to the Americas. It means inventory restocking of raw materials and goods that can build production, as well as retailers. So for the next 12 months, you have to be bullish if you believe that the presidential election is headed to a Trump victory. As it relates to freight, then for the next 12 months, this is good. Now, there may be, look, I completely understand that there may be serious consequences or serious issues that happen down the line with a tariff issue, and the deficit is a real concern. But those are not what we're talking about today for the next 12 months. Those issues will play out a lot longer and perhaps many more years, but not something that we should be worried about over the next 12 months. What we're talking about is reducing capacity and expansion of volume. You can't help be bullish about that.
I love the energy.
Dude, this is the most bullish I have been.
I feel it. So I also want to talk about I just actually threw something out there that it hasn't manifested yet in terms of what I've seen in some of the data. So I've got the LMI pulled up here, the Logistics Managers Index for inventory levels. In a pull forward, I'm ordering just in case environment. This thing is in green. So if we show this is anything above 50s expansion, anything below 50s contraction. We've been largely contracting inventories since a year ago, over a year ago. So they ordered too much, they got it down. And then you see a little bit of a spike there in March, but if you looked at the IOTI, if you remember on your quiz later, the IOTI spikes in February because of Lunar New Year. That explains the inventory growth in the spring this year, which quickly receded. According to this and other economic data, inventories aren't expanding at a rapid pace. Now, I just talked to Zach Rogers, Dr. Zach Rogers, one of the people that creates this morning, and he said that the retailers actually saw in June, their LMI inventory levels was 35 or somewhere around there, which is massive contraction. The industrial upstream providers was 52.
Yeah.
So marginal expansion. So they're building this upstream.
They need raw materials.
They need raw materials.
They worry about those raw input goods. The retailers have a little bit more time. But what I think we're seeing is that the inventory burn down is taking place. We're seeing a resurgence of that, and I think we're seeing the early signs. Because remember, these products that have been ordered, if you're going to go order production in China, that stuff is 6 months. It takes, we're doing some promotional stuff at Firecrown, and we're ordering backpacks that are, we need a 3 to 6 month lead time just to get that order in. Like if I don't get the order if I don't wire the money in the next week, I'm going to miss the holidays. Is basically the message. And you think about the retailers don't see that inventory in their supply chain until it actually gets into their distribution center. So that chart where you showed IOTI very well explains exactly it reinforces what we're talking about, is that inventory is coming. And it's going to show up. It hasn't yet, and it will show up in the next couple of months, and it will show up in the data. And when it does, the retailers could have excess inventory that will be largely explained through tariffs.
So okay, we've covered demand. Inventory looks good. I actually am doubling down on your bullish sentiment based on the inventory numbers. Now I want to go back to you're a transportation manager, transportation service provider. We're looking at the NTIL, which is the spot rate less estimated total fuel surcharge. This is something that tracks relatively closely. It's the NTIL. It tracks relatively closely with rejection rates, but it is a spot rate figure. Therefore, it is subject to inflation and costs of operation and things like that that move over time that the OTRI does not. Looking at this chart, we're only slightly above 2019, but it's starting to level out. The question to you then is, if demand conditions look so good, what are we looking at through the second half of the year with things like this?
I want to make sure we're very clear when we say so good.
Yeah.
What we're talking about is looking forward.
Right.
We're talking about the next 6 to 12 months, which is, this whole show is dedicated to the next, really a 12-month timeline. Like, we're not here to talk about the next 5 years. We're here to talk about the next 6 to 12 months,
Right.
which is where we spend most of our energy. What we're talking about now will start to be felt in the freight market within 2 months, let's say,
Right.
Domestic freight market. What this chart is actually showing us is that the NTI basically is not falling as sharply as it has in the past related to the July 4th holiday. It's showing some technical momentum. It could sort of trough off in the month of July and August, because that's usually a historically soft season anyways. But I don't expect it to go anywhere near where it was in past years. And as you pointed out, the number is going to be higher because of cost inflation. But as we are removing capacity, because that's the other part of this, is like, you talked about this and everyone called you nuts when you talked about the fact that we had something like, was 129,000 more trucks. Like, I don't remember the number.
25% more.
It was 28%, but you were saying we need to reduce that capacity. And when we did the math, it was really the first quarter 2025 that we were, if you look at the amount of expansion versus contraction, to sort of match the state of the economy. And I think that thesis in terms of balance still holds. If there are stimulating factors, which I am making the argument that there will be, due to policy changes. And look, you can sit there and point out reasons of why some of these policies have longer term issues. And we can have that conversation. But anytime we've seen a change in how the government regulates or stimulates the economy, it shows up in freight. And these impacts are going to be felt, and they're going to be big. And it's going to change the availability of capacity, because it's going to be harder to find trucks, and that's going to be bullish. Now, the question then is, how long will that cycle be, which will be for a future show. But for today, if you're looking into the second half of 2024 and the first half of 25, you can't help but be bullish on freight.
I am bullish on freight, but what does this chart look like here the next 3 months?
I think we'll see it dip a little bit, like I said, in July and August, but I don't think it's going to go anywhere near we saw in the last couple of last couple of years. I think it will. I think it's largely, it has set a bottom. It is going to have to get back to that. Look, they're not operating on artificial credit any longer.
Right.
Like, these loans are insane. Like, if I gave you a loan that is cheaper than the cost of capital today, 3.75%, for 30 years, you didn't have to pay it back for the first 2 years, you're naturally going to stay in the game.
I'm going to put it into T-bills and make 2% rips.
Of course you are. That's what you would do. And so that money's gone. And so now the people that are operating trucking companies have to make a profit. Here's the other thing that we're talking about. We've talked about this before, is there is the cash flow element of trucking, which you can operate a company that loses money but still generates cash flow. But those operators that have not made a profit, when they go to buy new equipment, are going to find that the new equipment prices, are up as much as 40% of what they were back before 2019. And when they go to buy this equipment, which we're now 5 years past that, we're 4 years into COVID, we're 4.5 years into COVID, your replacement cycle is happening. So yes, can they run out that truck for 8 to 10 years? Yes, their maintenance costs go through the roof. Drivers want nothing to do with it. And so these long dated trucks. The other thing is, if we see construction come back, if housing comes back, it's going to drain a lot of the available labor from trucking, which is also going to be bullish.
So you're painting a picture to me where I see this index, NTIL, here in the next 6 months having an event, having a significant breakout event.
It is quite possible.
Yeah.
I don't know that I'm predicting at this point,
Okay.
but I would say it is quite possible. The risks for supply chains and shippers is definitely on the side of a capacity crunch. It is absolutely something that if you're running a supply chain, you better be thinking about, because if you don't, you're going to run the risks of not having trucks. And we haven't even talked about the hurricanes.
No.
Like, hurricanes are a factor too. That certainly could create an accelerating moment.
They're largely unpredictable, not in the sense that we can't see them coming for a few days out, but
They show up as these sort of black swan-esque types
exogenous
of
events that you can't really,
forecast.
Yes, they can happen, but we're never certain. So the last chart I want to throw up here before we go to Q&A, because I think the purpose, I think everything that we've said, we're bullish on the next 6 months for the freight market in terms of we're getting closer to equilibrium of supply and demand in the market. Logistics Managers Index, 2 other components. Now, this is independent of FreightWaves data, sonar data. It's a survey, it handles things independently, but these 2 indicators here, we've got Logistics Managers Index for transportation capacity, which measures the amount of available equipment, drivers, trucks, however you want to put it, in the mountain white line, and in the non-mountain white line, there is transportation prices. This is correlated significantly well with our NTI as well as the OTRI. When we see freight cycles shift, these 2 cross.
These inflection points, like, you don't even know what the chart, you don't even have to know what the chart says. If you look at those inflection points, historically, this is when we have seen a change in regime, if you will. And that is why, again, getting back to the bullishness, the LMI is reinforcing. And it's important to note that the way that this index comes about is for universities to put it on. It's free, it's available. You can get it on the LMI website. We also have it inside of Sonar. We have absolutely zero influence over this. This is something that's done through survey data. It's called a diffusion index, which anything above 50 means you think that particular question is expanding. Anything below 50 things is contracting. What this index is saying, if you go look at it, the shaded white line, or the shaded version of the LMI is the
Capacity.
The capacity, and the other one is the prices. And so
They have an inverse relationship.
And so what we're seeing is when they change regimes or direction, they flip, it's telling you that you're on the movement of the pendulum is swinging in the favor of carriers. Now, we're going to hear from the large public carriers about some not great earnings reports. Now, one of the reasons that you're hearing that is, like, look at JB Hunt's report that came out, was it last night or the night before?
Last night.
Dedicated wasn't great.
Intermodal.
Their intermodal was a bit soft. Remember, a lot of it's contract freight driven. Is a lot of those pricing decisions were made because of the conditions in the first quarter. And
earnings are lagging.
Earnings are significantly lagging. I remember we wrote an article. It was actually what came out after JB Hunt's article. I wrote it. It was right after JB Hunt's earnings, and it was about basically the bottom, like basically saying on the way up. And that was right after a lot of the big public companies came out with really abysmal earnings reports in Q1. And I had some people, Seth Holm, who's runs a hedge fund, and goes, "That's a lot of balls to call it at this moment." And he's like, that's a pretty ballsy move. And I was like, earnings are a lagging indicator.
So slow.
And what we are talking about here is looking forward. And I want to remind you, because we've talked about this before, is there will be people who have contradictory information. Dr. Jason Miller is a great example of that. Dr. Jason Miller has been wrong by 6 months and almost every time there's been a turn. 2020, he was incredibly negative about, in July of 2020 at our 3PL summit, incredibly negative about the second half of 2020 because he was looking at lagging government data. In 2022, he also was wrong about the trucking market because he was 6 months behind and mocked us for calling a freight recession when clearly in his mind, his data didn't show that.
Right.
He also said that the second half of 2022 in containers would be one of the best second halves because he was drawing on old lagging data. And the thing is, yes, if he's looking at things from a 6 month lagging indicator, it looks bad because it was 6 months ago. But I'm saying going forward, our industry is going to have a great second half, or a good second half, and potentially an even better 2025.
Yeah. I think a lot of these data points, of course, you have to keep in mind.
And if you tuned into our show here at State of Freight, you know that we have been almost like afraid to call it. I am going on record, and I will own this if I'm wrong. I am going bullish, and I am super pumped about the direction of what's going to happen in freight. I am tired. We're tired in freight of playing defense. Let's play offense. Let's go out and play some offense for once, and let's get this industry back to moving momentum.
All right. Well, let's get some Q&A in here and answer some of these people questions, because I know you got some fiery responses ready.
Oh, I bet I do. We always do.
Let's go. Let's get spicy.
Love the enthusiasm, guys. Thanks so much, as always, for being here to share your insights. If you've not already, you can go ahead and submit those questions through the Q&A box in your console. Also, I know lots of you are tuning in on X and LinkedIn, so feel free to put your questions in the comments there, and we'll filter through those as well. First question for you guys. It says define bullish. Are we talking about freight going up 5%, 10%, more?
It's all about momentum. So, I'd be reluctant to put a number as at 5 or 10%. 10% would be massive amounts of movement. I don't think we're talking about something of that degree. But I think what I think we're talking about is, at least this is what I'm talking about, is we're moving away from shippers having absolute power over their carriers into a situation that, if we're not at equilibrium in terms of a shared level of sort of the market is stable, then we are certainly moving towards that. We are certainly in a position where the market's stable, and we potentially are moving to a direction, and could very well see this over the next 12 months, is a large capacity crunch, which could take price. I wouldn't look at volume, because volumes haven't been the problem here. No. I would look at more at the risk to price and those routing guides breaking down because of what we're seeing.
Yeah, service too. And when service fails, that's when the most inflationary pressure becomes evident, the sense of urgency. And I think some of the things we're talking about are reasons to prepare for the market being less like it is today, in the way that, you can get transportation capacity and service pretty easily without a lot of disruption. The likelihood for that going away quickly is becoming
increasingly obvious.
Increasingly more the case. To the extent of a COVID level event, I don't think either of us is saying that, but I think there is going to be a shift in the pricing pressure for sure. It's already showing.
Let me ask you a question. If Donald Trump is serious about 60% tariffs on China, and he wins the election, and he puts out notice, because I imagine they're going to give companies at least 6 months. I mean,
maybe.
Well, but that is a massively disruptive thing.
Yeah.
If there is a situation where we believe in the second half of 2025 that we're going to see a 60% tariff on imports, how flooded are we going to see container volumes be? It's going to be insane. So the bet against inventory restocking is either a bet against a Trump victory, so you don't believe Trump's going to win, therefore we're not going to have a new tariff regime. Okay, that's an argument, and you have sound facts. Or Donald Trump is not serious. And I have not met a tariff that Donald Trump has not supported, especially on China. China is the boogeyman in Washington.
To him, for sure.
But it is even for the Democrats.
This feels like a 2017-18 type environment.
And do you remember how bullish we were in 17? You remember it was September of 2017. I was at the McLeod conference.
That's 2019.
No, this was 2017.
Oh, 17.
I was at the McLeod conference, and I wrote an article. I don't even think I even had my own name in it at this point, because we were writing them under that.
Right.
And it was about rates are about to be like rocket ships. This feels very similar to 2017, where you had the tax cuts, and you had the pre-stocking for inventory run That's what drove the 2017. ELDs were there as well, but actually what happened with ELDs is everybody thought there was going to be a massive expansion of a massive contraction capacity, so everybody rebuilt it. This time that's not happening. So we're seeing capacity contraction at a time when there's a lot of government policy that could have a profound impact on the way the economy works. Even this is 1980. If Donald Trump puts these kind of tariffs on the economy, this is 1980. This is going to be a change of trade policy that hasn't existed since China reopened. That is how significant of an event a 60% tariff and a 10% global tariff could be.
And then we had Harvey that year too, which
in 2017
gets blamed for a lot of the freight market stuff, but things were building up behind all of that triggering event.
All right, guys, next question. This person says, I think the sanctions on Russia provoked global inflation and that Trump will remove these and therefore we'll see global deflation and then rate cuts and then a hot market again. Do you agree?
Russia's a conversation that I'm not even sure on policy. I mean, certainly Donald Trump has been has talked about not wanting to fund Ukraine and not send weapons. I don't know if that actually, I'm not at that point, that's a foreign policy conversation that's a little bit outside of where we spend our time and our energy on. The question is Europe's going to continue to keep those tariffs? Most of that flow of product was on between Russia and Europe, and less so Russia and the United States. Right? If you go look at the trade data, Russia to the U.S. is actually not a factor.
Nothing.
Here. There was an enormous amount of sanctions. I don't know if a Trump administration would actually lift sanctions. I don't have a perspective on that. I don't even know if that would be, that's just well outside the sort of things. Does it stroke inflation? Not so much in the US. If anything, it made our products, we see natural gas explode in terms of demand, the shipments to Europe. A lot of those sanctions are frankly positive for the American economy because we produce so much. And so I don't know that we would see a reversal of that.
Yeah, it would just create an environment that just helps us do more of what we're already talking about doing, which is kind of this deglobalization and kind of controlling more of the resources and materials and things ourselves.
And so much of the, if you look at
that is inflationary, by the way, to an extent.
If you look at the presidential sort of policies over the last, say, 40 years, a lot of it has been America's standing in the world and how we interact with the world. That's how, whether we're talking, really since Ronald Reagan on, a lot of it has been America's position in the world. And it's been a very global-centric sort of orientation. That is what we're talking about, is a complete change in a not let the world figure it out. There are certainly consequences of those policies, but at the same token is that you could see a lot of reacceleration of the American industrial base, because it's going to happen. There may be some detrimental outcomes in some of that, and there certainly will, because anytime you have big policy shifts, you're going to have losers. But you also recognize that it is going to happen.
Yeah.
Autos are a great example. Auto manufacturers have built production plants to avoid the tariffs that were put on it, and the ability to manage the supply chains here domestically.
There you go.
Japan figured that out in the 60s.
All right, next question for you guys. It says, how do you see cross-border trucking between the U.S. and Mexico and Canada being affected by Trump presidential triumph?
I've been asked this, and I've been thinking about it a lot. And so USMCA, I hate that name, by the way. USMCA was a Trump policy.
Right.
He has talked about 10% tariffs globally. I don't think 10% tariffs are a huge factor because I don't think they have the kind of profoundness that you would see on China. I don't think the Trump administration would completely cut off trade with Mexico, our number one trading partner, and implement tariffs that do that. Now, there's a lot of conversations about border skipping that happens with these tariffs. I could see them attacking what they call the Temu rule, whereas anything under $800 doesn't have to deal with the whole customs and tax and stuff. So I think we'll see a situation where small ticket items could be attacked, particularly for e-commerce. But I don't think we'll see a shutting down of the borders of trade.
Yeah, and a lot of these, the cost of production down there would overcome that tariff gap anyway.
Yeah. I mean, you got to be bullish in Mexico.
Yeah.
Like the big winners in a lot of this is going to be Mexico anyways. And so I think that's sort
Mexico
of
has some challenges to deal with, especially on the western side of that country. But there's infrastructure being built right along the border, and that's where the majority of the growth is occurring. We actually had a webinar this week where we showed the growth of border crossings. Port Laredo already expanding, like it's kind of pulsating out more and more. El Paso, big one, as well as over there in Nogales and Calexico. All of them are expanding. They're showing expanding.
Port of Houston
activity.
is doing an expansion of its ports.
So it's happening. It may not be manifesting quickly as we kind
Stuff takes a long time.
Yeah, it takes forever.
And I think, one of our customers that's deep in Mexico has suggested that the official government data is just significant lags. I mean, you think the U.S. is lagging? Imagine the Mexican government data, that they're underreporting the amount of investment going into Mexico. And yes, it is certainly Chinese companies building production. And I'm hearing a lot of that is that Chinese companies are very worried about these tariffs if we're not. And they're bringing production into Mexico and making investments in the United States that they recognize that they need to do.
Yeah.
All right, next question. It says, I'm curious to understand the Asia import volume increases into Latin America 30% year over year the past 2 years. What are the drivers here?
Well, it's exactly what we just talked about,
Yeah.
is that what they're doing is those imports are coming in from Asia into Mexico and perhaps Canada, but we're talking about Latin America specifically, is they're going into Mexico. And look, it is one thing, I want to bypass these, I want to zone skip, border skip, if you will.
Yep.
They're trying to bypass some of the tariffs and some of the restrictions on trade that exist. But they're also, you have to remember that not only are we looking at products that are being shipped from manufacturing in China to Mexico to be repackaged into the US, there's also a lot of manufacturers. One of the things about like Japan in the 1960s went out and when China opened up, so 1960s was a lot of industrialization of Japan. And then it was the Koreas. And then what we've seen is that those companies then went into China as soon as it opened up. The Japanese are a large reason that China industrialized because they took that expertise. They ran out of resources in Japan. China doesn't have a lot of resources to begin with, and invested in China, which brought a lot of that production up. That was a big share of how they were training the Chinese. The same thing is happening. The Chinese manufacturers, worried about trade issues, are going to Mexico and making investments, which is the reason you're seeing products flows, because raw materials and components are moving into Mexico for assembly, bound for the United States.
Yeah, raw materials and a little bit of that zone skipping.
All right, next one for you guys. It says, why do you think government is not going to waive off the loans that carriers received during COVID? I think they will waive it off and the capacity glut will continue. What's your perspective?
So it's interesting. Biden tried to do this.
He did already.
Under 100, it was if your loan was less than 100, or maybe it's 200, I can't remember the number. I think it's less than 100,000. Is that they were going to waive it, and that actually got botched. So
the Treasury Department said nope.
Sorry about that.
Yeah.
If you took out a loan hoping that it would be forgiven, you're going to have to pay it. So.
Yeah, they've already shown that they're not going to do that.
Take one more here. It says, when has the market last been equal, where shippers and carriers were working together?
If you want to look at equal, I think mid-2017 was the last equal. You could even argue that 2019 was equal. It was a freight recession with a lot of bankruptcies, but like the market is always, capacity always is trying to catch up to where demand is, either on the top end or bottom end. You could argue that perhaps we are in equilibrium right now. I mean, look at the crossover of this chart. But look at how sharply that regime change happens. It is interesting. Look at the depths of that. So
the LMI.
The LMI, yeah, people can't see it. So you could argue right now we're in equilibrium, and we're about to get into a soft crunch.
Yeah, I think the longest term, like equalized state has been like, you probably have to go all the way back to
2014.
Yeah, 14-ish.
Well, 2014 was a good year. It was really 2012 to 2014 where the market was so boring and stable.
There was nothing. It was steady growth, et cetera. That's probably the period everybody thinks is normal. But we have been moving up and down the supply-demand curve since 2016 in a pretty volatile fashion.
Maybe you have to go back to regulation. Where, but I went and looked at some old newspapers articles on newspapers.com about trucking, and you could have ripped the date off of an article written in the 1950s, the 1960s, 1970s, and 1980s, and you would be like, "Oh, this stuff could have been written today."
Wow.
Like the players change, but the things that they're talking about almost identical: fuel prices, insurance. Regulation, all of that. Crazy. Economy. Now, the only thing they didn't talk about was fluctuating rates and freight brokers, because those didn't exist. But all the other things that truckers care about still were on top of mind of executives back then.
It's a free market.
All right, everyone, that is all of the time that we have for today. So Craig and Zach, thanks for being here. It's always great to hear your insights. And thank you so much to our friends in the audience for participating and asking so many excellent questions. Before we sign off, just a quick update that we'll be hosting our August State of Freight webinar in our studio for a live audience. And we'll also be streaming it live at 5 p.m. Eastern on August 29th on FreightWaves.com, as well as X and LinkedIn. So be sure to mark your calendars to tune in. Also, just a quick reminder that our F3 Future of Freight Festival event will once again be taking place in Chattanooga, November 19th through 21st. You can get your tickets today at live.freightwaves.com. Thanks so much again for joining us.